I want to bring in Brian Jacobson now. He is multi-asset strategist at Wells Fargo Asset Management. Brian, good to see you. I want to start with this news about the hedge fund, Archegos. Last week, we saw that they had to unwind $30 billion in some holdings. How concerned are you that this hedge fund appears to be liquidating, and also about how widespread the pain could actually be beyond the banking sector?
Sure. So as far as our view right now is that it's nothing that we're overly concerned about. Obviously, it's having specific effects on specific stocks. And you mentioned a few of the banks that are involved in this where they might have losses on it, perhaps because of they're on the other side of the transaction. But it doesn't really look like there's a lot of what's called systemic risk emanating from this, so affecting the entire financial system. So it's very different from what we saw during the global financial crisis, where you saw very highly leveraged players all pretty much on the same trade. And then that created a system-wide risk where you had a banking system that was quite fragile. Now the banking system is very well capitalized, a lot more robust against shocks. And from what we can tell is that this was just almost a one-off case where you had some concentrated bets that were highly leveraged, but it's not necessarily the case that it's symptomatic or emblematic of how other hedge funds were positioned where you'd have some sort of contagion effect.
Brian, I was just looking over at the financial sector, down over 1% right now. How much do you see this as a buying opportunity for Credit Suisse, for example, or Nomura, which is down over 13% right now?
Yeah, so thanks for that question. My team and I, we've been really looking at some of the various trades that we have on in anticipation of a continued economic recovery, more of an economic restart, moving to a rehabilitation, to an actual recovery like you would typically see out of a recession. And we do think that banks could be a continued beneficiary of it. So I can't talk about specific names, but the financial sector in general is one that we think should stand to benefit over the next year, if not longer. If you look at the performance of the financial sector, it's really underperformed most of the major indexes over the last few years. And we think that they can benefit from lower default rates, higher yields as far as with that net interest margin that they can earn, and then just the continued economic recovery. Thus far, a lot of the loans that they have made, it's more that they've originated them and then had them with government guarantees. And that's not quite as profitable as if they were actually originating loans to hold on their own books, where you could actually have a little bit wider net interest margins.
Brian, I want to branch out and talk a little bit more about the broader market and the economy for a moment. I know that you say we could be in for a mini recession in the middle of next year. Tell us why you think that and what might precipitate it.
Yeah, I think that it has to deal with just how unique the economic downturn was, and then how unique the economic upswing will likely be, and so far how it has been. As I mentioned earlier, this isn't your typical garden variety economic recovery. It's an actual economic restart. So you have to go from the restart to rehabilitation to an actual recovery. Sometimes if you look at almost the projections for what growth could look like with that economic restart and rehabilitation, which will take place over most of 2021 likely, is you can get some overshooting as far as just a huge surge in growth and then settling down into a more sustainable rate of growth. And that settling down can give the illusion or the appearance of actually entering into like a mini recession, where it's a slight economic downturn as you get to a more sustainable pace for that actual legitimate part of the economic recovery as part of the economic cycle. So that could be one of the surprises, is that in 2022, that because of how strong growth is in 2021, you get a little bit of an overshoot, a little bit of a deceleration, mini recession like we saw maybe in the mid 1990s, where if you blinked, you kind of missed it.
Now, Brian, you have said, however, that you still remain selectively positive on equities. You do mention cyclicals, value over growth. Just diving into that a little bit, where more specifically are you looking at, or should investors really be looking at for 2021?
Yeah, for 2021, we're really overweighting. I don't really like the value growth distinction just because, price to book, price to earnings, whatever the valuation metric is, it's not really a value metric. It's actually a market multiple. The valuation is what managers do when they do a discounted cash flow analysis. And really, there should be value in growth names. And just like you would expect that these value names should have some growth opportunities. And so we usually think of it more in terms of the cyclical versus defensive nature of the companies or the sectors. We like the more cyclical ones, which do tend to cluster within the value space, as far as, let's say, with you might have financials and you might have industrials as being very good areas to be looking. And that's actually where we're overweighting our portfolios for this leg of for the market recovery.
Brian, what about outside of the U.S.? How much of your portfolio is dedicated to emerging markets? And also, are you playing it all in the bond market? Because we know that yields there have finally stabilized. What's your outlook for yields in the bond market for the rest of the year?
Yeah, so we have seen a big move up in yields in the United States and somewhat an increase around the globe, but not nearly as much what we saw on, say, the 10-year Treasury yield here in the U.S. And so as far as on the bond side of things, we still don't think you're really all that well compensated for the risks that you're exposed to as far as possibility of yields moving higher. But there is still, we believe, some good value in, say, high yield in the United States and even in the emerging market debt, although not nearly as much as what we saw even, say, just a month ago, which is why we actually like overweighting outside of the United States, more within the equity portion of a portfolio, especially emerging markets. Now, you do have to be cautious with emerging markets. There are political risks there, and not all emerging markets are created the same. If you look at the multiples on Chinese stocks, for example, those look quite a bit higher than if you were looking at, let's say, stocks in India or stocks in Brazil or stocks in South Africa. So it really is an eclectic mix of exposures that you can get on the EM side, but we actually like that eclectic mix. We think that that can bring some good growth potential to a portfolio and also diversification benefits.
Continuing this, conversation just a little bit on yields, I believe I was reading in your notes that during this economic cycle, you're imagining that yields could go up as high as 3%. Everyone saw that chart that we had up on those yields just a moment ago. Of course, we've seen that when these yields are rising, it's put a huge amount of pressure on equities. If we do see those yields rise to as high as 3%, how would you advise some investors, kind of protect against that pressure?
That's a very good observation, is that probably by the time this economic cycle is done, and who knows when that will be, is that it could be like where were we with yields in 2018 or back in 2013, which was around 3 to 3.25%. We might be a long ways from there. And so as far as the way that we're managing it is we're keeping the duration shorter in anticipation of higher yields and favoring taking on more of the credit risks. So that would be like the higher quality, high yield debt, looking outside of the United States, say, as far as emerging market debt, some of the opportunities there where you can get a little bit more yield. But I think that you do really have to be very careful, maybe take that more active approach to managing it such that you don't have too much duration risk. There is a temptation to be a yield hog, which is that you just try to go wherever the yields are the highest. But you do have to be very aware of the default risks associated with having those higher yields as well.
All right, we're going to leave it there. Brian Jacobson of Wells Fargo Asset Management, thanks so much for kicking off the week with us.